Early decentralized finance projects set out with a specific goal: to take physical, real-world assets and put them on the blockchain. For Project Sigma, this meant targeting real estate in emerging markets and rigid, complex legal entities. The strategy relied on the assumption that applying blockchain technology to these heavy, illiquid assets would be enough to circulate new global wealth. But real-world friction cannot be coded away. The ambition eventually stalled against the weight of physical reality. On the ground in emerging markets, the operational reality proved far more difficult than the initial hypothesis suggested. The team encountered local regulations that were often undefined and a complete lack of modern financial infrastructure. These roadblocks meant that once an asset was tokenized, it remained frozen, unable to be traded or scaled across a network. This diagram illustrates the path of an illiquid asset. It moves slowly before hitting consecutive bottlenecks: manual appraisals, legal hurdles, and shifting regulatory requirements. Without the ability to clear these hurdles in real time, the asset loses all momentum and sits idle. A financial system built on immobile assets is limited by high friction. It is a structure that cannot scale. This friction forced a total strategic shift. Project Sigma halted operations to perform a teardown of what actually constitutes value in a digital environment. They applied the first principles methodology used across the I'm-in ecosystem, moving away from assumptions and back to pure logic. This approach focuses on three specific pillars: precision, utility, and velocity. In a digital network, an asset's value is defined by how fast it can move. Intrinsic worth matters less than the velocity of the capital. To build a high-velocity system, the project moved away from the fringes of emerging markets and toward the center of global finance. The strategy pivoted to liquid RWAs, U.S. Treasuries, local bonds, and blue-chip equities. Unlike real estate, these assets have massive existing demand and rely on standardized, trusted frameworks that allow them to move instantly. This high level of liquidity provides the necessary framework for automated collateralization. Contrast the two models. Left, a building tethered to a manual appraisal. Right, a treasury bond connects to a smart contract node for instant verification. These contracts assess and settle liquid assets instantly, removing human intervention. This automated process enables continuous settlement. Moving from illiquid to liquid assets was the technical engineering upgrade required to make this level of settlement possible. This strategic pivot resulted in the Sigma BankAI ecosystem. This architecture functions as an innovation engine. It takes local liquid markets as fuel and processes them into a single high-velocity stream. By removing the friction of illiquid shadows, the engine produces value certainty, a state defined by predictable mathematical results. This proves that liquidity is the primary requirement for institutional adoption in decentralized finance. Rather than fighting the friction of the unknown, the project chose to upgrade the financial engines that already power the world. The shift illustrates the result of questioning a failing hypothesis and adjusting based on market evidence and logical constraints. The ecosystem is ready to operate, guided by mathematical precision instead of abstract promises. By anchoring the architecture to liquid certainty, Project Sigma moved decentralized finance from a theoretical model to a functional, operational system.